Okay, I'm going to start the webinar with this question. What would you do with $100,000? If $100,000 was given to you tomorrow, maybe you won it in the lotto, what would you do with that money? Now, your answer that you give will be a reflection of your wealth creation education. One option is to put that money in a savings account, nice and safe. Another option might be to put it into shares. Another option might be to go and buy a property at 80%. Now, there is a rule that says never borrow more than 80% so you can avoid paying mortgage insurance. Now, that's a rule that's out there. I don't agree with it, and I'm going to demonstrate to you why later, but some people like to follow that rule. And the fourth option might be to buy two properties with an absolute minimum deposit and maximum lending. Let's have a look at what would happen if we followed each of these options in turn. Now, the first option is do nothing, put your money into a savings account. Now, most savings accounts, you'd be lucky at the moment to get 3% interest. So let's see what would happen to our $100,000 if we added 3% every year for 10 years. Now, the bottom line is we'll end up with $134,000. Now, what a lot of people don't understand is that inflation in this country is controlled by the lifting and lowering of interest rates. And the target inflation is 2 to 3% per annum. So if you're putting your money into a savings account, you're basically doing nothing with it because the 3% interest you will receive will be taxed as earnings. So you'll lose a third of it to the tax man, but also, and we haven't taken that out of there, but also you'll only be keeping pace with inflation anyway. So even with a compounding rate, you're going to get taxed on it every year on that 3% you've earned. So a third of it's going to go at the 32.5 or 37% tax bracket, and you're only going to end up with about 2% left over, which is only barely going to keep pace with inflation. So putting your money in a savings account is doing nothing with it. Even if you're getting 4 or 5% return, you're still not going to get anywhere near where you need to be to stay in front of inflation when the taxman takes a third of the interest earned. Option 2, put your money into shares. Now, if you put your money into shares and you got a respectable return of 7% per annum for 10 years, which is about the average that's been reported on the Australian stock market. Now, obviously, you wouldn't get that every year. It'd be up and down. One year you get nothing, next year you get more than that. But if we say we got 7% for 10 years, there's a rule called the 7-10 rule, which says that if we earn 7% for 10 years or 10% for 7 years, we'll double the value of the fund. Let's have a look at what happens to our 100 grand if we put in shares and we consistently get 7% every year. Okay, and we end up with 196,000. So we've just almost doubled, call it doubled our money. Not a bad outcome. Certainly better off putting our money there than we are into savings, as long as we're putting them into nice, safe, blue chip shares. But still, are we going to be able to retire on that sort of money? Okay, let's take a slight detour and look at historical house prices in Australia over the last 50 years. Now, Winston Churchill said, "I can see far into the future because I have studied the past." Now, it's quite an insightful thing when you speak about it. Ask yourself, do you believe that things happen in patterns? Do you think that history repeats itself? I believe it does. It's hard to believe that in 1970 you could buy a house in Sydney for $18,500 or in Brisbane for $8,500. But the people at that time would have been just as daunted and just as intimidated by the size, the cost of the property and the mortgages they have to pay, because they would have been on about $2,000 or $3,000 a year total salary. That's why we used to have 1 and 2 cent coins, because things were a lot cheaper then and everything was relative. And if you think property is expensive now, then you really need to just think about that bit more and think, well, actually maybe it's just relative. Now, people do say that property prices are more expensive now because there are multiple of the average income is much higher than it was back then. But there's a simple explanation for that, and that explanation is that you can now borrow money for a longer period of time in Australia. Back in the 70s, you could only borrow money for 15 years. So with the same amount of disposable income, you had shorter time to pay it off. so therefore you couldn't borrow as much money. Now you have a longer time to pay it off, so you can borrow more. Now, if I said to you today that buy as much property as you can because in the next 10 years it's going to triple or to quadruple in value, you would probably tell me that I'm completely nuts. But that is indeed what happened from 1970 to 1980. Have a look at those prices. Sydney more than tripled. Brisbane more than tripled. And, well, Brisbane in fact quadrupled, and Melbourne more than tripled. And then let's say that then happened and it's now 10 years from now and we've just tripled or quadrupled, and I say to you, look, don't sell it, hang on to it because it's going to keep going. You would tell me that I'm crazy. But yet from 1980 to 1990, house prices tripled again. Sydney 64,000 up to 185. Melbourne 40,000 up to 140. And Brisbane 34,000 up to 108. And even in the 90s, when we had the recession that we had to have, we still saw very, very strong capital growth where properties almost doubled. 115, 125 grand increase in Sydney. We had a $100,000 increase in Melbourne, and we had an $80,000 increase in Brisbane. And that was when the country was going through some serious structural changes with the Reserve Bank being made independent and all sorts of problems. From 2000 to 2010, we have seen this has continued to occur. Sydney, Melbourne, and Brisbane. Brisbane more than doubling. In 2016, we now see, this at the end of last year, we see that the price in Sydney was 1.1, Melbourne 900, and Brisbane has gone up, as you can see, even more, about 165. And the decade is not even finished yet. We've still got three more years to go. So as you can see, this is going to happen. It's going to keep happening. And the reason why it happens is because as the population increases, the amount of land stays the same. So suburbs that were once lower class become middle class. And suburbs that were once middle class become upper class. There's suburbs all around Sydney, Melbourne and Brisbane where they have those little, what they call workers' cottages. They call them workers' cottages because workers used to live in them. But now they have highly paid lawyers, doctors, corporate executives living in them. Why? Because as the population increases, so does the number of highly paid people. The highly paid people push out the middle income earners who push out the lower income earners. It's been going on for years and it's going to keep going. What's the moral of the story? Buy real estate and hang on to it. Okay, let's look at option 3. What if we then decide, okay, well, let's go and buy a piece of real estate. Well, the most expensive piece of real estate we could buy with that $100,000 would be a $400,000 property with a 80% loan of $320 and a 20% deposit of $80,000. Now there'd be stamp duty and legals incurred, which is another $20, so we've now spent our $100,000. Now why on earth would we do that? Well, the reason why we would do that is because in that same time, and we'll rent it out for $400, in that same time in Australia, we can expect that the property is going to near on double. The average over the last 50 years is actually more than doubled. It's about 2.5 to 3 times depending on the capital city in a 10-year window. So it's not unreasonable to expect that a $400,000 property will go to $800,000 based on historical trends. What does that mean? Well, that means that we've got an equity of $480,000. So we took our 100 grand, put it into a property and ended up with $480,000. Now why did we do that? Well, the reason why we did that is because we weren't invested in 100 grand, we were invested in 400 grand of property. And that 400 grand moved in the market and got us to where we are there, and we've ended up with a greater result. Now you'll note that I haven't changed the loan amount because that's the worst case scenario where we've just had interest only the whole time. Now if the value has doubled, so has the rent, and we now have a situation where not only have we made more money, but we also now have a surplus passive income from the rent. What if we went and got into 2 properties? Well, as you can see, the answer is already there on the right, but let's buy 2 properties by the skin of our teeth, 5% deposits, pay stamp duty, pay mortgage insurance. Okay, what happens to those properties? Well, they're now doubled in value, the mortgages have stayed the same, and we have 420 grand in each property. Add that together, you've got $840,000. The rents have now doubled too, and we've got a surplus income probably in the vicinity of $800 dollars per week passive income. So let's be honest with ourselves. Which one of those 4 options did you choose at the start when I gave you the options? Did you pick a savings account? Did you pick shares? Did you pick 1 property, or did you pick 2? Remember the results. Now, there's a lot of people out there who are smashing their money into their mortgage on their own home. And that is half right. The problem with your own home is it doesn't produce an income. And if you're pumping all your money into your own home, all you are doing is working for money and then using that money to pay down the loan. You're not actually got a property working for you like an investment property does.
Hi there, I hope you enjoyed that. If you think someone else could benefit from that, make sure you share it with them. We'd really be grateful if you did that. And if you want to get into property investing, if you're serious about it, just send us a message. Let's have a strategy session, let's go through it. We have clients all over Australia, in fact, all over the world. And we talk to our clients either in person or via Skype, really easy to do. So don't hesitate, get in there. It's only $297 for a strategy session, and it's 100% guaranteed refundable if at the end of it you didn't feel it was worth your while. Cheers.